Hi everybody, welcome back to ETP Finance. My name is Mark and I'm here to share with you my personal experience in finance and also help you master your wealth. Today I want to talk to you about my top 3 stock picks. This was my most liked and watched video of last month, so don't forget to give it a thumbs up to help me with that YouTube algorithm. So I already have up on the board my top 3 picks from last month. You can see here we've got TripAdvisor, In Canada, and Norwegian Air Shuttle. So when I recommended them to you, it was on a Sunday right before market open of September. TripAdvisor was at $37.07, In Canada was at $5.82, and then Norwegian Air Shuttle was at $3.59. So TripAdvisor finished at $38.43, which would have given you a return of 3.67%. assuming you bought and hold it for the whole period. In Canada finished at $6.11, 4.98% return, again if you had bought it and hold it for that entire period. And NWAR finished at $3.97, which would have given you a 10.58% return. So assuming you had an equal position in all three of them, you would have finished the month up 6.41%, which is not bad for 1 month. So the picks I'm going to give you in today's video are a lot more defensive in nature. I truly do believe a recession is coming to North America within the next 14 months. But a lot of the picks today have proven to endure recession-like conditions. A lot of people tend to avoid equities in those type of conditions when consumer confidence is down or when business spending is down or any other unfavorable macro trends. These companies are proven to succeed in those type of conditions. So the first one's going to be Waste Management. Waste Management is a US company headquartered in Houston, Texas. They were founded in 1968 and are an environmental services company. For any of you who know, they're the trash cans which have the WM label on them. I'm sure you guys have seen them. They're all over the place. So in the last 5 years, this stock has actually climbed 150% and quadrupled over the last 10 years. It's also outperformed the S&P 500 index as well as the Dow Jones Sub-Trash Index. So sorry, not the Sub-Trash Index, but the Dow Jones Sub-Disposal Index, which was founded in 2013. And they have about 95% of their business coming from the United States. So Waste Management operates in an oligopoly, meaning that market share is limited to a certain number of buyers and sellers. In this case, they are the most dominant player in the oligopoly, as we're going to see in a second here. So I've built a competitors table. I'm going to go ahead and put it up on the screen now. There's about 6 or 7 other trash companies based out of the US. Their main competitors are Republic Services and Waste Connections. But you can see that Waste Management accounts for 43% of the market cap in this industry, if you just look at the graph here. So they're clearly a dominating force in the industry. If we're just looking at some of their ratios now, you can see that they have the second lowest trailing PE and the third lowest forward PE. So obviously we're more concerned about the forward PE here. If we're going to be buying a stock or are thinking about buying a stock, we want to know what's going to happen in the future. So they're also one of 3 companies in this industry to pay a dividend, and they have the second highest forward dividend, although it's only about 10 basis points less than the highest. If we look at their price to book and their price to sale ratios, you can see that they're actually the second highest in their peer group, which could mean that the market is pricing them at somewhat of a premium relative to their competitors. But they are the largest company in the peer group, so it's no surprise that they also have the highest earnings before interest, taxes, depreciation, amortization, EBITDA for short, and also the highest EPS, which is earnings per share. Their PEG ratio is also reasonable in comparison to their peers. I believe they have the third lowest, and all that is the PE ratio, but it takes into account growth. So overall, I'm recommending this company too because I believe that they're non-cyclical in nature, meaning people are going to be accumulating trash regardless of whether there is a recession or not. They have about 67.8% of their landfills under contract for 21 years or longer, some of them 50 plus years. So they have subscription-like cash flows, which can almost allow the company to run on autopilot. They have an extremely strong market share in this oligopoly, which can overpower their position, and they also have an extremely low beta of 1. So that's why I'm recommending Waste Management. Let's go ahead into the second company now. So everybody knows what this next one is. It's McDonald's. So McDonald's is a fast food restaurant that operates globally. They have broken down their geographical revenues into 4 separate segments. They claim to serve over 70 million people per day, but their 4 main geographical segments include the US, which is their main market, their biggest market, where they started. They also have the international lead markets, which includes countries such as Canada, Australia, France, Germany, and the UK. They have high growth markets, which include China, Italy, Korea, Poland, Russia, Spain, Switzerland, and the Netherlands. And the last category is their foundational market and corporate, which is kind of just a corporate adjustment segment. So in my opinion, their lead international market segment is the greatest opportunity for growth for them, as it's the only segment which hasn't experienced regression in their total revenues over a 5-year period. So you can see up in this graph here, it breaks down the 4 categories in terms of total revenues, total operating income, total assets, and total capex. Okay, so looking at their performance, some of these numbers I'm going to give you are a little bit unrealistic, but if you had invested back in McDonald's in 1979 and held that share to date, you would have made over 17,000%. So not all of us are 40 years old here, but that's 40 years of pure excellence. For the people who aren't 40 years or haven't had 40 years of stock market investing, just to give you another perspective too, if you had bought McDonald's 5 years ago, you would have made a return of 121%. And if you bought a position 1 year ago, you would have made 28%. So really, that's a history of fantastic returns, even with declining revenues in the past 5 years in their main markets, such as the US. McDonald's obviously benefits greatly from brand recognition. You can't go to many countries worldwide and talk to somebody on the street who doesn't know who McDonald's is, or doesn't know what McDonald's is. This stock also has an extremely low beta of 0.33, meaning it's not overly volatile. Okay, so instead of building a competitors table for the industry analysis, I'm actually just going to go through Porter's 5 forces. For those of you who don't know, Porter's 5 forces is a tool which you can use to evaluate a company's competitive environment. So the 5 forces are competitive rivalry, the bargaining power of customers, the bargaining power of suppliers, threat of substitutes, and threat of new entrants. And the higher the force, the more competitive it is for McDonald's. So first off, just looking at the competitive rivalry, there's obviously a high number of firms competing in this space. They're generally aggressive in nature, and they create bidding wars for the real estate they're bidding on, as well as the prices. So they tend to undercut their competition in terms of prices. So just for those 2-3 reasons alone, I'm going to have to assign competitive rivalry an extremely strong force. There's very low switching costs as well. So now the bargaining power of customers. So as I just mentioned, there's extremely low switching costs, which means it isn't expensive to switch brands, suppliers, or products. There are a ton of providers in terms of fast food restaurants or just food restaurants in general. Substitutes are highly available, so in my opinion, consumers have an extremely high bargaining power, which can lead to lower prices and margins for McDonald's in the long run. I'm going to say that this force is considered extremely strong as well, just to the sheer amount of options available to the customers. Okay, so bargaining power of suppliers, this one's a little bit different. Now, how many options do you think McDonald's has to supply their restaurants? The answer is plenty, okay? So there's often a lack of regional global alliances among suppliers, which bodes well for McDonald's because they're always in competition for McDonald's business. So this one, I'm going to say that they have greater power to negotiate their prices, and for that reason, this force is pretty weak. So threat of substitutes, this is another strong force, as I kind of already outlined in the bargaining power of customers and the competitive rivalry. Like I said, there's extremely low switching costs. It doesn't cost anybody really anything in terms to go to a different fast food restaurant. If I want to go to KFC, if I want to go to Tim Hortons, if I want to go to Burger King, all I have to do is drive there or order from there instead of McDonald's. There's no cost to switch brands. I would also speculate that most consumers prefer a variety of food rather than going to the same place over and over again, so I'm going to have to say that the threat of substitutes, again, is an extremely strong force. Threat of new entrants, here's the last force. So this discusses the potential for new companies to come into the fast food space. Now, although setting up a restaurant, a singular restaurant, might not be overly capital intensive for someone who's, let's say, has $500,000, it's kind of difficult to replicate the value chain that McDonald's has built over the past 40 years. They operate globally, so for that reason, I'm going to have to rate that one a moderate force. So overall, just recapping, we have competitive rivalry, which is an extremely strong force. We have the bargaining power of customers, and another extremely strong force. The bargaining power of suppliers, we're going to have to say that's a weak force. Then we have the threat of substitutes, again, extremely strong force. And then we have the threat of new entrants, which is kind of moderate, as they already have a very established footprint in this industry. Okay, so overall, I'm recommending McDonald's to you guys because they have an extremely low beta. They benefit greatly from brand recognition. They've been around an extremely long time, and they have proven to be resilient in economic downturns. So they're entrenched worldwide. I'm confident that their cash flows are going to be managed appropriately over the next decade or 2, 3, 4 decades to come here. And overall, this is a low risk, low volatility bet. So another very defensive stock in nature, but a cornerstone to any dividend growth portfolio. And speaking of dividend growth, they pay about a 2.34% annual dividend. Okay, so last pick here is a commodity. I'm going to be recommending to you guys gold. So gold is generally said to be inversely related to the market, or sorry, not inversely related to the market, negatively correlated with the market, meaning that when the market's going up, gold is going down, and vice versa. So if we're expecting a recession to come in the next 14 months, this might be a good play to hedge your portfolio against that. Stocks will typically benefit from economic growth, while gold will benefit from crisis and distress. So gold is widely known as a safe haven for investors that are fearing economic turbulence in the near future, which I might be. So just the first graph I want to show you guys here, I'll put it up on the screen. Between 1970 and 1980, the S&P remained fairly stagnant, while gold appreciated almost over 2,000% between the second and third recession in the 1970s. So how can markets move or markets not move while gold is having the run of its lifetime, only to really predict the third recession of the 1980s? So the recessions here in this graph are outlined by the gray period, and you can see here gold is the yellow bar. And during times of recession or right before the recession, gold will tend to increase, which is a good indicator that a recession is coming. So next graph, I'm just going to show you the price of gold against the commodities S&P 500 index future, also against the copper future, and then also against the price of oil. So you can see here, as those three things, the commodities index, the copper futures, and the crude oil futures have been declining, gold has actually been on a steady incline. So this is just more proof that it's negatively correlated with the market here. So that's pretty much it for gold. There's three main selling points to gold for me. First one is it's an inflation hedge. So like I've mentioned a few times now, it's negatively correlated with the market. The second one is deflation protection, and deflation is defined as a period where prices are declining and the economy is burdened with debt. So again, gold is seen as a security that's negatively correlated with the market. This is something that hedges well against that. It provides good diversification in your portfolio in general. So, and the last thing is geopolitical uncertainty. So with plenty of uncertainty between US and China trade, as well as the geopolitical tensions in the Middle East right now, for anybody assuming that World War III might break out, or that there is some more economic turbulence coming our way in the next year with the American election in 2020, the Canadian election in about 2 weeks here. This is again a good asset to diversify your portfolio and provide you a hedge against economic turbulence. So again, that's all I have for you guys today. I hope you guys enjoyed it. Don't forget, last month I would have made you 6.41%. Hopefully you guys take a look at these stocks too. If you enjoyed the video, don't forget to like it, subscribe to the channel, and share with a friend if you learned something. So as usual guys, have an awesome day. See ya.